Hello traders, Shawn Lucas here, head trader at the Apiary Fund. So good to be with you today. We are going to talk about the RSI, the Relative Strength Indicator by Wallace Wilder today. There's some things that we can talk about, maybe some things that you may not have thought about in using a momentum indicator like the RSI, and then obviously some of the more notable concepts surrounding the RSI, the ones that everybody knows about. So we'll cover both sides of that fence and hopefully make some good progress in our understanding of the RSI today. Before we get started, for those of you who are at Apiary Fund, we are happy that you're here. Glad that you came to support us. If you like these videos, please make sure that you click the like button down at the bottom. It helps us to understand if we're hitting the right topics. It helps us understand if we're if we're doing the right thing here. So make sure that you like it. That way we know that we should keep continuing to do this. For those of you who are not part of Apiary Fund, welcome. We hope to trade with you someday. Our traders at Apiary Fund are the most fantastic traders on this planet. We are so fortunate to be able to trade with them and to develop together. That's what we do at the Apiary Fund. So for those of you who are not part of the Apiary Fund, come join us. Give us a try. We've got a free trial on our website. You can sign up and just get started, No harm if you don't like it, you can come in, sign up for the trial, and then go on your merry way. But I think what you'll discover is that Apiary Fund has a hive of fantastic traders and a fantastic group that I'm so happy to be a part of. So there's your invitation. Now come join us. Well, let's jump in and let's talk a little bit about the RSI. RSI stands for Relative Strength Indicator. It is, there are a lot of indicators in the world right now. I mean, if you think about it, you can have an infinite number of indicators. There's no end, because you can always adjust something in a math equation, and voila, you have a new indicator, right? So there's a lot of selection out there when you're choosing an indicator, which one is right for you. And the industry's kind of divided them up into little categories. And the RSI happens to be in the category of what they call a momentum indicator. What that means is that it's trying to measure the momentum in the market, the rate of change. When price moves, how fast is it moving? How much strength is behind that move? That's what Wallace Wilder, the guy who created the RSI, that's what he wanted to know, because he recognized in the market, he recognized that there are some times, when the market just catches wind, it just catches a little fire and it starts to take off. And what he wanted to do is create a math formula that he could run in the background that would help him see those moments more clearly, right? So he created the RSI indicator, and that's what we're going to talk about today. So his default, so if you look here on the screen, what you're going to see is I've got a price chart up on the top section of the screen, and I have the RSI indicator on the bottom section of the screen. So any indicator, there's almost always variables that you can adjust with any indicator, right? Wallace Wilder preferred to use a 14 period in his RSI. What he's saying is that he's only measuring the past 14 candles, past 14 bars, to come up with the current value of the indicator. So if you think about it, this point right here is the result, or the final answer of the math formula that measures the previous 14 bars. So 1, 2, 3, all the way back for 14 bars. So it's using just that data to calculate that point right there. Does that make sense? So if you expand out your variables, so like for example, if you expand this from a 14 period out to a 50 period, you're going to get a different result for that value. That value is going to give you a different result. So let's just see how that changes, how that will change the result. So let's go to RSI, and right now we're at the default's 10 here, but let's change that to 50. Let's click OK. And so you can see, if you compare those two results, the top one measuring the previous 14 bars, the bottom one measuring the previous 50 bars, 50, you can see that the results, the value that math equation spits out is different, right? Up here, the result is about approximately 50, 60, let's say 65. The top number, let's say, is 60, let's say 64. So the top number is 64 right here on the 14 period, and over here you're down at about 52 or 51. You see, very different results. So as you're sitting down and you're using an indicator in your trading, it's so important that you learn to tune that indicator to the market. Whatever it is that you're looking for. Maybe you have a longer term perspective and you want to get rid of all of the up and down noise that happens in the market. Well, it's simple. All you're going to do is you're going to use bigger numbers in your variables, right? Because it's going back and averaging and doing math over a bigger set of numbers. If you want to be really fine-tuned and catch every swing and every zig and zag in the market, then you use smaller numbers. And that's just kind of the way it works. So that's the first takeaway, I guess, for this discussion is, make sure that you understand the market that you're trying to trade, and then adjust your indicators to trade according to that market. So for example, in the market, you'll have long-term trends. So on this chart right here in front of me, we'll have long-term trends, we'll have short-term trends, and we'll have intermediate-term trends, right? So obviously, these are short-term. I'll just draw a couple in right here. Short-term, they're short-term trends, right? Those short-term trends make up longer-term trends, intermediates, for example. So your intermediate terms, more like this, right? And then those intermediate term trends make up even longer term trends. So this is all part of a bigger, longer term downtrend right now. Does that make sense? So one of your first objectives when you sit down and you're trading a chart technically, you're trading the technicals on the chart, you got to make sure that you know which trend you're trying to catch, because there are trends all over the place. And so you got to make sure you know which trend you're trying to catch, and then you can make the adjustment to the indicator. Pretty simple concept, right? I think most people understand that. Most people who've spent any time in the market at least will understand that concept. All right, let's cover the second point that I wanted to make sure we understood about the RSI indicator. And this is the most simple way to use an indicator. Use the RSI indicator. On your RSI, you're going to have a couple of different lines. Let me clean up this chart real quick. I'm going to take the 50 off. So on your RSI, you're going to have lines. Those lines are going to be, you'll have two lines. One is high, one is low on the chart. The high line is measuring at about the 70 line. You can make adjustments and change where you want that line to be, but the default is set to 70. And the low line, the bottom line, horizontal line, is set to 30. So two horizontal lines, one set to 70, the bottom set to 30. And the idea behind the RSI indicator, when Wallace Wilder first came up with the idea of writing a math formula to help him identify when the markets get these little speed, these big speed moves in the market, is he noticed that if that market moves really fast and really far, then usually there's a reversal, right? He's like, look, if that market moves, think of it like a horse in a race. If that market moves as fast as that horse can run, and as quick out of the gates and as far as that horse can run, then usually that horse is going to be tired and going to need a break, right? So the same thing happens with price. As price takes off and it's fast and strong and moves a lot, it's going to get into a condition called overbought, right? And what we're expecting, or what Wallace Wilder was expecting, was a reversal at that point, right? So anytime the market crosses above the 70 line, for Wallace Wilder at least, like right here, what he's saying is that you can expect a turnaround, or at least a rest in the market, a rest or a turnaround or something. But as soon as it crosses above that line, historically, it's moved too far, too fast, too quickly. And so you need to look for that market to change. Now, don't misunderstand indicators. Just because that market has crossed that line doesn't mean that it will automatically turn around and go back the other direction. That's not the way this works. What it's doing is it's saying, hey, look at me right here. I've moved a long ways really fast and I'm tired. So what do? You jump in, right? What do? You just recognize that, hey, it's at a state where it could, emphasis on the word could reverse at this point. Same thing on the bottom, right down here. You get to that the market drops really fast, really strong over a long period of time, or a long distance, and it's tired, needs a break from all of this selling that's going on. So you say, in your mind, hey, look, the market's run a lot. I need to maybe look for an opportunity to get into a reversal here, because this is a good place for it to reverse if it's going to happen. Okay? So that's the second thing, the second takeaway for the day. I've got 5 of these takeaways. So the first one was make sure that you match your indicator to the move that you're looking for. Second one here is look for these overbought, oversold conditions. That is textbook RSI analysis, okay? Third one, again, textbook, right? There are conditions in the market where things don't line up. Everything doesn't line up in the same direction. So you might have one thing happening in the market while something else is doing something completely different, okay? And those are conditions called divergences. Called divergences. You have 2 states. You have states where the market is converging, everything is moving and supporting itself. All the different indicators, all the different moves, price action, everything is converging. It's all converging into the same stream, right? And that stream is all moving in the same direction. The second state is a divergent state, where now all of a sudden price is doing one thing, indicators are doing another thing, this and that is doing something different. Those are called divergent moments in the market, and those are also highlight opportunities for a trader. So in this case, look at this here. Let's clear out the lines. But look at this here. You've got price moving in an upward trend, right? Higher highs, higher lows, and slightly higher movement. However, look at this trend on the RSI. It's moving down. It's like, man, I had so much momentum moving it up, and little tiny moves are pushing me all the way back down. And so in order to get all the way back up to here, that market has to make a much bigger move, much more momentum, much more speed in it, and it's failing to do that. So it's not measuring the direction of the market, it's measuring the magnitude of the speed and the force and the distance behind it. And here is saying, you're not giving me enough market. I need more out of you. I need more out of you to continue this trend higher, and you're not giving it to me. So what happens is during divergence times in the market will tend to reverse. Those are good opportunities to look for a reversal which is exactly what happened. The divergence, the state of divergence will ultimately end, and you'll get convergence, where everything works together in the right direction. And so that is also that's number 3. That is also something that we can learn from using the RSI indicator on our charts. Okay, all of that's pretty textbook material. Now I'm going to cover an idea, a concept that may not be so textbook to you. This one happens to be what I call momentum shifts. So shifts in momentum. So sometimes what you'll see during long extended trends is that the market will adjust, the RSI will get stuck in a range. So if you look at this, instead of getting up into this overbought area, which is your typical overbought, there's a shift. That overbought condition shifts down, right? And as long as this trend is persistent, then these become, the times that it pierces that area become overbought. So if you look at that, now we're shifted. It's a zone shift, right? Instead of using up the entire range from 0 to 100, it's only using up the range from 0 to 50. So that's a shift. It's a zone shift, right? And so you can use that zone shift the same way as you do the overbought, oversold conditions. I did look for another zone in the high end now. So this is an uptrend. That previous was a downtrend. And what we see here, again, is a zone shift, right? Now, instead of you can see that market's in a strong uptrend during this phase. And every time it hits these low points, boom, 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 those are indications to buy. They're oversold in an uptrend. That's an oversold condition in this uptrend, and you need to look for the reversal to happen. Now that's an important thing, because you'll never get a buying opportunity based on your RSI. You'll never get a buying opportunity down here because the zone has changed. You've got a zone set up, and it's working on a different scale, a smaller scale, right? From 100 down to roughly 40 in this case. So the scale is from 100 on the high side to 40 on the low side. I guess it's really from 70 down to 40. So this is important to understand, because the last concept I want to make sure that we understand is that every indicator has times when it works and times when it doesn't work according to the standard definition of the indicator. And a lot of people will say, I don't like to use this indicator or that indicator because it doesn't do a good job in this market condition, right? And it's widely known that RSI doesn't do a very good job giving you overbought and oversold conditions during trending markets. That's where the indicator tends to break down. That's its weak spot. And every indicator has a weak spot with its strengths, right? So that's the indicator's weak spot. Now, if you understand this concept of zone shift, you can still use the indicator to identify overbought conditions and get multiple entry points in the direction of that trend, right? So if you've got a zone shift on the low end of the scale, then you're always going to be you always want to be taking the overbought conditions because you're trending down. And so you can actually use that indicator in a trending market and still get good results if you understand this concept of zone shift. So important concept there. Well, there you have it. So let's do a quick review, and then I'll take a couple of questions, okay? First, you need to, I'm a huge proponent of this. And those of you who are at the Apiary Fund, those of you who are trading with me, you understand this concept better than most. You got to make sure, if you're going to use an indicator, you have to make sure that you've tuned that to the market that you're looking to catch, right? Whatever that trend is you're trying to catch, you have to tune that market to catch that trend. So yes, Willis Wilder uses a 14-period RSI. That was his standard. That's what he was trying to catch. But you can adjust that indicator to catch the move you're trying to catch. Second thing is the very basic concept, you know, and this indicator is using a math formula to identify overbought and oversold conditions, right? Traditionally, anything above 70 is overbought, anything below 30 is oversold. You can adjust those indicators, those horizontal points, up and down. So if you move it from a 70 up to like an 85, boy, you're only going to get a handful of overbought conditions, but those are generally going to be stronger signals than a 70. So you use the RSI to identify overbought, oversold conditions, and that is just based on a contrarian idea that at the end of a big, strong, fast, momentous move in the market, it's tired and it's going to reverse and move the other direction. That's the idea behind the indicator. You can make adjustments to help to fit your personal trading style. Third thing is that we can use this this RSI indicator to identify divergence in the market. Times when things are working against itself. You know, this is saying one thing, that's saying another thing. That's a divergent state. Usually divergent states will correct so that everything's moving the right direction for you. So use the indicator to help you identify divergent states, okay? Fourth concept is to understand the concept of zone shifting in your indicators, okay? So you'll have in trending markets especially, you'll have the market, the indicator will move in its zone, and you'll see it on a chart. It's not hard to identify. You'll see it. When you can use that zone to help you give that same overbought condition. However, if you see that the market is never hitting overbought conditions, that usually means that you're in a downtrend and you only want to take the moves that are in the direction of the downtrend. So you're only wanting to look for periods when it crosses the zone and is turning back down and moving in and confirming the trend, the downward trend in this case. So make sure that you understand this idea that an indicator, you know, the standard way of using the indicator would say, wait for a 70, wait for a 30. Well, in this case here, we're going to wait for a 55, a 55 for an overbought condition, and then we're going to start looking for opportunities to sell it. Maybe we look for a 3-bar reversal, maybe we look for a consolidation breakout, something along those lines. But very, very useful to help you use that indicator in a more during periods when it's not at its best, right? The indicator is not at its best. Look for the zones that will help that indicator give you better signals, if that makes sense. Okay, all right. I think that's our discussion for the day. What kind of questions do you have? What have you seen anything out there?
Can this work on any time frame?
So the question is, does this work on any time frame? Absolutely. Yeah, it doesn't matter. We're looking at a 5-minute chart. The same 70-30 conditions, those overbought, oversold conditions will happen on daily charts. Only instead of being, in an overbought condition every 30, 40 minutes, you're going to be in an overbought condition every 30, 40 days, right? So you use it on a higher time frame scale, you're going to have to wait longer periods before you're overbought and oversold conditions. Very simple concept.
How does the RSI actually differ from the stochastic?
So the second question is, how is RSI different from a stochastic? Both of them are momentum indicators. Both of them attempt to identify different overbought, oversold conditions. RSI uses one math formula. Stochastics use a different formula. Both of them are trying to accomplish and see the same things. Both of them will have advantages. One will have an advantage over another in one condition. The other will have an advantage over the other in a different condition. So that's an important concept to understand. RSI is a very simple, it's a very simple measurement, right? It literally just takes bar data, high, low, and it makes a calculation whether there's momentum by saying, is this bar higher than the previous bar, and by how much, right? And that's how RSI comes to be. Stochastics, on the other hand, uses a more complex math, and it calculates some averages in the process, and it does a similar concept where it measures, do we have momentum? But it uses a little different, a much more complicated math formula than RSI. So RSI gets some knocks because of its simplicity. Stochastics get some knocks because of its complexity. So, either one of them will have, again, just remember, either one of them will have periods where it's a good indicator, the right indicator to use, and periods when it's not. So, one more question.
That last one is a good one.
So basically, I should use this indicator when markets consolidate or trade in a narrow range. That question, when it consolidates and is in a narrow range, consolidations will be more sensitive. So your signals will be more sensitive in consolidation periods. Consolidation means the market is trending sideways. Okay, so your indicator will be more sensitive in sideways because you don't have a trend that it's fighting, right? So you don't have lower lows, lower lows, lower lows, lower lows, lower lows, lower lows. You have a low, a high, a low, a high, a low, a high. And so the indicator can pick up quickly those shifts from overbought to oversold. So it's really excellent in a consolidation market. The second answer to that is to use this zone shift concept that we talked about, and that will also help you pick up really good signals in trending markets. Your job is to just identify the zone, and then if you are in a trending market, use the RSI indicator to help you pick up those turning points when the market continues its downward trend. So both of those are good. You just have to know when to use it and how to use it in the different market conditions. But yes, consolidations are great. All right, traders, thank you for this opportunity. We'll wrap it up for the day. Wish you all the best of success in your trading. We'd love to trade with you if you're out there on your own in your basement or in your living room trying to figure this out on your own. Come join the good folks here at the Apiary Fund. They're a great group, and we've got some fantastic instructors on board with us, and come give us a shot. We'd love to have you here. For those of you who have enjoyed this session, make sure you like our presentation. That does wonders for us and YouTube. YouTube likes it because they're saying, hey, we've got content here. We've got content that people like to watch. So if you like it, please let us know. It would do us a huge favor. Thank you. And we'll see you next Wednesday. See you, everyone.